You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed, like last week's episode with Jerry Parker, which I actually thought was one of the most important episodes Jerry and I have recorded over the years, and where we really got into the core of trend following. So if you don't mind me saying, if you have not listened to that one yet, it really should be the next one that is queued on your phone. As you may know, the aim of the podcast is to inspire you to become the best investor that you can be. We want to be provocative, but without being polarizing. We want to challenge consensus narrative and to advocate how to think critically about investing in an uncertain world, and to provide you with a framework and mindset that we believe is truly robust. And if you want to help us achieve that goal, what we ask of you is that if you can comment, if you can continue to send your questions, if you can share these episodes, and not least, if you can rate and review them in iTunes and Spotify, we would greatly appreciate it, as it's the best way for us to see that you get some value from the time and dedication we put in each week to create these episodes. And as long as that continues, we continue to do them. With all of that said, Alan, great to see you. Great to have you back on the podcast. How are you doing? How are things where you are? And more importantly, how did you celebrate St. Patrick's Day?
Well, everything is very well here, Niels. It's a beautiful sunny morning in Dublin. We're in the midst of the long weekend. It started with St. Patrick's Day on Thursday, but we've having an extended weekend. So it's been a nice break. We've got Six Nations rugby to look forward to this afternoon as well, which is a big thing in my house, but may not mean as much to you. So yeah, it's a lot to look forward to today once we've had our discussion.
You know, you might be surprised here, but I actually saw the Irish beat the All Blacks in Chicago a couple of years ago, if you remember that game.
I was at that one too, yeah. So
you were at that one too?
That was
wow.
one of the
well,
highlights.
I didn't see you.
Yes, no, that was a great day.
And it was a very sunny day, I remember. That's right, as well. Yeah, absolutely. Well, small world. Anyways, I'm going to do a quick market wrap because, of course, it was an interesting week. All eyes were on the FOMC outcome this week. And as expected, Powell and the FOMC raised short-term rates by 25 basis points to a range of 25 to 50 basis points. And market participants interpreted Powell's statement post the meeting as decidedly hawkish. This flattened the U.S. Treasury curve further, with the inversion now seen in 3 years and 5-year notes exceeding the yield of the maturity of 10-year notes, a signal usually pointing to a slower growth in the future as interest rates increases and in turn slow sectors of the economy most dependent upon leverage. On Friday, we had two Fed officials, Bullard and Waller, pound the table for more aggressive rate hikes to counter the current inflation rate and help maintain the Fed's inflation-fighting credibility, if you can call it that. But I do think that in many investors' opinion, the Fed has already lost that credibility, frankly, and not just because of the transitory mistake, but also for adopting an average inflation approach without defining the average time period. The market is fully buying into the prospects of the Fed that, one, they can raise rates every meeting this year, and two, be successful in engineering a soft landing, an economic slowdown that eases price pressures without raising unemployment. But I think it's fair to be skeptical that the FOMC will be able to raise rates that aggressively going forward. Much of that depends, of course, upon the outcome of the Ukrainian-Russian conflict and the change, or rate of change, I should say, in month-over-month inflation readings should come down later this year. But anyways, Alan, always interested in hearing what you've been keeping an eye on in the last few weeks since we last spoke.
Yeah, so much going on in markets. It's hard to isolate a few market moves that have been particularly interesting. But I think, as you say, the Fed very much the focus this week, and really interesting when you dig into the details of what they call the dot plot. And so that's what the various members of the FOMC are projecting in terms of interest rate rises. And if you compare what we see in the March projections versus December. Some participants are now seeing rates rising to over 3% this year, which is a massive about turn versus where we were 3 months ago. So it just highlights what we've been saying on this podcast and elsewhere, what a difficult job they have, but it's really been a big shift in the last 3 to 6 months. So much going on in markets. I know commodities have been a massive focus with everything going on there. But what I'm finding interesting is we're seeing big-ish moves in currencies and possibly the start of interesting trends in currencies. And I started off in currency markets in my career, so I'm always they're probably one of the first markets I'll always go to look at, with dollar yen moving up to test close to 120. And it's quite interesting to try and paint a picture of what's going on in currencies, because we've had the euro declining, but it was possibly more of a euro story than a dollar story. You've had the dollar yen moving up, but again, it's possibly more yen weakness. The Chinese renminbi has been relatively strong against the dollar. I look at the dollar versus Swiss. That's one I also look at, and that's quite range bound. So you've got a lot of cross currents, but the dollar yen one is definitely interesting, because we had the Bank of Japan, basically indicating that they're not going to be in a hurry to do anything in terms of monetary policy. So this potential rate divergence is what seems to be driving the move at the moment. And this always brings me back to one of the big trends that was in markets early in my career, which was the big dollar yen move up in the mid 90s to 147, which was a real classic trend and carry trade. So I'm always curious, are we possibly on the verge of another one of those moves? Too early to say that definitively, but easy to see how the conditions might be in place for that to play out. So interesting how, as well, what often you get is you get a big move in one market, and then that starts to have knock-on effect on other markets. And obviously Japan is an importer of oil, and often tends to get influenced when you get a big move up in crude oil. So you have a move in one market, and then you're starting to see the spillover in currency markets as well. So I think that might be something we touch on as we go through the podcast, but certainly it's interesting times, I would say, in currency markets.
Yeah, and I'm very excited by the fact that, one, you have a lot of experience in currencies, and actually that you are starting to see some interesting opportunities that may arise, because actually I think currencies has probably been the worst sectors for trend followers for the last 15 years.
Yeah.
It has just not been an easy sector to be trend following, frankly, because central banks have been holding a pretty tight grip on their coordinated policies. But as you rightly say, this is changing, and we are creating this divergent environment, which is so conducive to trend following, and it sets us up for interesting times ahead, not just in currencies, of course. From my point of view, if I look at the week from a trend following perspective, I keep an eye on, 5-10 different managers where I can see daily data coming in, and I try and sort of see what's been going on. And as far as I can tell, despite relatively big moves in some of the markets, it has been a relatively quiet performance week for trend followers. Energy and grain prices sold off quite significantly. At some point, we had crude oil down $30 from its recent high. We had wheat trading 30% lower, also from its high 10 days ago. But as mentioned, I think the trend followers, we mentioned this many times before, trend followers, we are first and foremost risk managers, and we size the positions inverse to volatility. And I think that's a lot of what we see right now. And so as volatility has been increasing since February, I think a lot of managers have been, reducing their position size and vice versa. Of course, for others, and I think everybody knows who I'm referring to, they don't adjust positions during the trade, and they wait for a new signal to do that. So there might be a little bit of difference between those two type of approaches. And I think also that this ability for us and this focus from trend followers to be risk managers first and foremost is actually one of the key reasons why investors should not try and time or trade in and out of their investment in trend following firms based on what they think the markets might do next. Because, we're already doing this. We're already actively managing the exposure in each of these markets. So I really don't think it's a good idea. And frankly, just like the worst thing that we can do as trend followers is to miss a great trend, the worst thing an investor can do is to miss a great run in trend following performance, just because they're trying to, can they time their investment a little bit better and be too clever. I mean, the last 4 months, if you missed that period in the trend following space, your performance will look vastly different, than people who are in it, for sure. Elsewhere in kind of the classical trend following portfolios, I would say there was also a little bit of a correction in the metal sector. So, but I do suspect that people had a pretty enjoyable week in fixed income on short positions. Equities, of course, could be a little bit to both sides depending on time frame, but there was obviously a very inspiring rally this week in equities. So they finished the week substantially higher. And as you said, currencies, interesting. I'm not sure exactly whether there was net a big move in the currency sector for managers, but certainly they're starting some interesting levels in some of the currency pairs. My trend barometer finished the week at 70. That's a very, very strong reading. We've been hovering around sort of 60, 70, 80 at some point in the last couple of weeks. And so it really is confirming the strong performance we're seeing from trend followers so far this year. Now, before we move on to the questions, we have one question from Abe that we need to deal with. I just want to say that there are more questions coming in, and I appreciate that. We're very grateful for those being sent in. Of course, info@toptradersunplugged.com is the email address. But I will just say that a lot of them are directed to Rich, Rob, Mark, and Jerry. So even if we don't bring them up today, it doesn't mean that we've forgotten about them. We'll just bring them up as all of the other guys come on in the upcoming episodes. But let's turn our focus on the question from Abe, Alan, and actually it's a little bit maybe outside our wheelhouse to be commenting on this today. So it'll be a good exercise for us to keep us sharp. But anyways, Abe writes, what are Niels and guest's opinion about roll harvesting strategies? I was, as a relatively newbie to this future space, intrigued to read Matthew Gomez's 2015 paper on a supposed roll harvesting strategy involving buying the most backwardated products in a group of products. Those spot returns are highly correlated, and selling the least backwardated. His approach is systematic, which I like and gravitate towards, but not really trend following, which I have struggled to implement. As commodities could have spot returns, those decline in steeper than the associated backwardated futures curve, leading to one purchasing highly backwardated products, even if they are breaking down and below their moving averages. What do you think of this role-focused type of approach? I think it might, and by the way, I'm still reading the email, so I think it might suit my personality more so than buying new highs, breakouts, which I haven't embraced, which I'm not embarrassed to say. Sorry, I'm messing it up here. I found psychologically challenging. So, and I think, Arvid, by the way, you're not the only one who finds it psychologically challenging to buy breakouts. Let me assure you of that. Anyway, thanks for your insights. So now, I'll be completely frank here. I have not had time to read the paper, but I know you skimmed over it and you are probably even more into these things than I am. So I've got some other observations, but Alan, I would love to just hear your thoughts about and see if we can help Abe a little bit on this.
Yeah, it's an interesting paper. I mean, it's a discussion of a particular strategy of capturing the roll yield that is evident in commodity futures. So by that we mean for markets in backwardation, if you're long the futures contract, it'll trade at a discount relative to the spot. But as that contract roll forwards, you're capturing that roll yield. And within this paper, they're looking at what I would call a relative value strategy. So you're long some commodities versus short other commodities, depending on whether each of those commodities are backwardated or in contango, and going long or short commodities that are correlated with each other to try and mitigate the influence of the spot price move. So I think it's a very valid strategy. As an allocator, in the past, I've allocated to different strategies, not just trend following, and to managers who use, multi-strat approach. So it is it's certainly not unusual in the industry for managers to have a relative value strategy or a carry strategy alongside a trend following strategy, because it does tend to be uncorrelated. It is in the broad category, as I say, of relative value strategies, whereas trend following is a directional strategy, and that could appeal to. I can see why it might appeal to somebody. What comes with that is a different return profile. I think the paper highlights that this particular strategy tends to be uncorrelated with equities and bonds, and I would guess uncorrelated with trend following as well. But what you get with a relative value strategy is that you won't tend to get that convexity that we really like about trend following, and the fact that when you get big moves in traditional assets, you'll often get really good performance and strong performance because you have that directional risk on in a trend following portfolio. In a relative value portfolio, you're going to be long some markets and short some other correlated markets. So you might continue to have an uncorrelated return profile, but it won't have that attractive characteristic. Carry strategies in general, and this is one of the subset of carry strategies, they do tend to be negatively skewed, whereas trend following tends to be positively skewed, depending on what time frame you're measuring over it.
And can you just explain that? There might be people out there who don't know what we mean by that.
Basically, when we talk about skewness, we're looking at whether you're getting the bigger moves on the positive side relative to the negative side. So what you tend with a negative skewed strategy, you tend to accumulate lots of small gains and then a big loss occasionally. Whereas with trend following, you tend to get more consistent losses and then the occasional big gain, and that can give you the nice positively skewed profile. And obviously one of the, we've been talking on the Allocator series about this as well. One of the downside of just looking at the Sharpe ratio is you're just looking at volatility versus return. You're not thinking about the overall characteristic of the return series to incorporate skewness. So it is an important metric to keep in mind. So yeah, interesting strategy. It is interesting how he touches on this, whether it might be more suitable to his personality, and that's fair enough. I mean, some people will say, well, I don't. The idea of buying high is difficult for me. Maybe that's a reason to invest with a manager who will do it for you if that's something that's challenging. But certainly, relative value strategies, carry strategies, they all have a place within a diversified managed futures portfolio, I would say.
Yeah, no, I think that's a great point, actually. And I would also add to that to answer Arby's question here that we've had the discussion actually a while back whether or not you should actually pursue strategies that quote unquote fit your personality better. And I think that a lot of people would make the case and say, yeah, you should definitely do something that you feel better about. But I also remember Jerry making a really valid point saying, well, that's BS, because frankly, you should pick the strategy that's going to be the most robust and most rewarding over time. It doesn't have to fit your personality, especially if it's a rules-based strategy. You just have to have the discipline to implement it. And I think that is actually a really, really good and very valid point. I'm not sure that there are many people who frankly enjoy trend following in terms of the profile. I think a lot of us takes a lot of comfort in it. And of course, we enjoy it when it's doing well. But I don't think we can necessarily say honestly that we enjoy it during the times when it's not doing so well and when it's going into one of its famous drawdowns and all of that. So, but I think your point, Alan, about if you want to do the carry trade and you want to implement that yourself, first of all, I will say I do think you have to be careful, because I do think it has inherent risks that are not obvious. And I think if you just look at what happened in nickel, which I talked to Jerry about last week, and of course is all over the news, where you just had some market movements that no one would have expected. That's what a carry strategy will get killed on, while a trend following strategy, for the most part, is kind of built to handle unexpected market moves. But if you really want to do that, Abe, and obviously that's completely your choice, I think Alan's proposal of saying, well, you should probably allocate some of your capital to trend following, but if you don't want to do it yourself, find someone to do it for you, someone with experience, and someone, frankly, who can give you that diversification anyways that you need in trend following. I think we've seen that again during what's happened this time around in February and March, that diversification is critical to be successful in trend following. You can't rely on just a handful of markets, and you certainly can't rely on a handful of markets in the same sector to do the work for you, because it could be completely unaffected about what's happening and you're missing out on lots of good trends happening elsewhere. So, but we're grateful for the question. Now, if there is like one or two of you sitting out there who don't really know what contango and backwardation really means, and I can assure you it is difficult to remember what exactly is it. So contango is when the price closest to us in terms of time is higher than future prices, and backwardation is when the price closest, or the spot price, is lower than future prices. That's what the two means. Did I get that right?
Yeah, so if you are in a backwardated market, if you're long, you'll benefit from the roll yield, and if in a contango market, if you're short, you'll benefit. Is the way I always remember it.
All right, let's move on to some of the topics that you brought along. They are very interesting, and I very much look forward to diving into these because a lot of things are happening at the moment. So it gives us obviously lots of things to talk about. Now, the first kind of topic you had, big picture, and there are lots of small kind of questions along that. Some of it where you actually have some comments to previous conversations with Rich and Jerry and so on and so forth. But it is quite an important and very fundamental question to the whole podcast, and that is what causes trends in markets. So let me allow you to give your thoughts on this broad topic.
Yes, it's interesting because obviously you've been talking to various guests, Rich and Jerry, I think in particular, about this idea of exogenous drivers and endogenous drivers of markets. And it's something that I think came from following the podcast where JP had his research around how, over very short time horizons, he was noticing significant moves in markets that appear to be unrelated to news events, which was interesting. And that's kind of indicative of more endogenous driven markets. And when we're talking about endogenous, is that it's just the inherent behavior, the interaction of the buyers and sellers in the markets by themselves without any external stimulus, I guess, might be more of an endogenous driven, whereas an exogenous driven move is something where that's very clearly something happens in the news and everybody reacts. So that, I mean, it's been interesting to track that, and it is linked then to the more general question: is okay, we're trend followers and we believe in trend following. So, but why do we get trends in markets? What causes trends in markets? I think probably the general view is, well, you get some news and the market responds to the news. And I think that's true. I mean, I don't think you can dismiss that. And the first thing is we have an economic cycle, and that tends to be the first thing. You get macroeconomic volatility, you get GDP expanding and contracting, and that tends to be, an important driver of different markets, probably more so certain markets. Like if you think about short-term interest rate markets, they are actually anchored on the policy rate. So they're very much influenced by an external factor. So probably less endogenously driven when you get big moves there, because they have a very much an anchor. Other types of assets are more sentiment driven, I would say. The second thing is that you do get random events like we've had recently. Obviously, we've had COVID, we've had the war in Ukraine, and these are very much, I would say, in the category of exogenous factors that trigger a move, and they're what I would call repricing events, because something significant has happened in the world and lots of assets have to reprice to a new scenario. So if you think about, what we're seeing in wheat, what we're seeing in oil. So we're saying, with COVID, we had a change in the macro backdrop, and everything had to reprice to that. So we know we're going to have less demand for oil, so the price had to go down. Now, what you tend to get in these scenarios is not just the first order impact, but you can get the second order and the third order impact. So it's kind of like, if you have a lake or something and you throw a big stone into the lake, you get the ripples coming out from the lake. So you get an exogenous factor is the shock that comes into the market. You get the first order impact, which everybody can see very clearly. So, of late, it's the supply coming out of the oil market or the supply coming out of the wheat market, and that's pushing up wheat prices or oil prices. But then you get the second order effect. So the second order effect in the case of oil could be that it's influencing the value of the yen. So I think exogenous factors do play a part, but where the endogenous element comes in then is it's the kind of the state of the market when you get that exogenous factor coming in. So the markets can sometimes be primed for a big move, and this is how you can get what you might think of as non-linear reaction. So the same type of event can have a bigger impact on the market depending on how people are set up. So for example, we saw a big reaction maybe in the taper tantrum to Bernanke's comments back in 2013. Why was that? Well, it was probably because the market had been conditioned to expect rates to be low for a long time. So people had the way market participants were set up was conducive to seeing a big move. Or if you go back to, the flash crash in whenever it was 2010, or even the 1987 crash, market participants were set up in a particular way that you can get, maybe not the most dramatic exogenous factor, and it's what I think Rich was talking about, tipping points and the idea of an avalanche, and it's this idea of the butterfly flapping its wings in Tokyo can impact the wheat crop in Chicago. So it's these small, depending on how the market is set up between the accumulated positions amongst the buyers and sellers, that an external stimulus will have a different impact on the market at different times, and that's why you can get bigger trends in response to some external factors at some points, and more muted reaction at other points. I think there's a couple of other dimensions to this, like why do we get trends in markets and why do we get big moves? And, obviously the behavior of the market participants as well, it's behavioral bias, that's how we all respond to the move. So we see the market starting to move, and obviously the market influences our perception. So the price rising, why were people interested in buying Bitcoin? Arguably, well, because the price is going up was certainly one of the reasons. So rising prices attracts buyers. Going back to the economic theory, Keynes had this idea that, he had a big observer of markets, financial markets. He was saying, the game of investing is like the pretty faces competitions. There used to be this competition in the newspaper where you had to pick the prettiest face out of, say, 20 people they showed. But the game wasn't to pick the prettiest face. It was to pick what everybody else thought would be the prettiest face. So you might have a perception, but that's not what you're really trying to predict. You're trying to predict, well, what will everybody else think? And then the question is, well, what will everybody else think that everybody else thinks? So he would say, it's like that in the market. So, we've got a scenario, dollar yen is moving higher. Will people see that and say, okay, now we've got a trend in place and the yen is behaving in this way, so I'm going to trade it that way. So the parallel in the markets is that the price influences not only our perception, but it influences what we think other people might perceive. That you think, well, other people will see this trend and think that that's the way to go. So that enforces that kind of trend following bias. So I think that's another factor contributes to trends in markets. And then the final factor, which I think is interesting that I just wanted to bring into this, is that one of the first things I read when I was starting off in the markets was a book by George Soros. It was the Alchemy of Finance, and within that he has this theory of reflexivity, and this is all about feedback loops. And his insight is that not only do you have this kind of bias, and actually I was just looking back on it just in the last couple of days, and he specifically talks about the trend following bias in the market. And he wrote this back in the 1980s, and he was particularly talking about currency markets. But his observation was that the price itself that then can influence the fundamentals. It's not like the fundamentals are happening as a separate thing. It's the fact that the economy is influenced by what's happening in the financial markets as well. So, a couple of examples of that are, say for example, emerging market currencies and emerging market debt markets. So if for whatever reason you get positive sentiment towards an emerging market and capital starts to flow in. So what happens is the local bond market will start to rise, the currency will start to rise. So that has positive impacts on the local economy. The rising currency will help constrain inflation. The rising bond market will reduce bond yields. That makes it easier for that country to service its debt. So you get what you call a virtuous circle, that because of the flows are coming in and because of that positive perception, it actually improves the fundamentals of that economy. All up until the point that for whatever reason sentiment might turn, maybe they use that funding, that cheap funding, to overinvest, or maybe they start spending too much and they get a current account deficit and everything goes in reverse. But the point is that you get these boom bust cycles, virtuous and vicious circles in markets, because the price that is derived in the financial markets then starts to influence the actual fundamentals. So it's very hard to say, is it endogenous, exogenous? There's so much going on in the markets at any one time. You've got the economic cycle, you've got the behavior of the participants, you've got how people are set up when you get this external stimulus coming in, and then you have this feedback loop between the financial markets and the real economy itself. So I think both are important. I think an interesting question that I used to get, speaking to clients, is, you can describe why you get trends in markets, and that makes sense, and particularly, people really, buy into the idea of fear and greed and all of that. But then what about those periods when we're not getting trends in markets? So what's happening then? It's an interesting question. And I think what you've got then is that you're just having fewer of these big periods of, more periods where more markets are in some kind of broad state of equilibrium. So if you think about crude oil going back to maybe the start of the last decade, say I think it was between, say, 2010 and 2015, it traded between maybe $80 and $110. And, broadly speaking, that's a market in, a broad sense of equilibrium, because, broadly the supply and demand are being matched at a similar price over time. But then over time, new supply came into the market. You had shale in the US, and so the supply started to outweigh demand, and then you started to get a trend. But I think these periods where markets are less trendy, I suppose you would say, could be periods when markets are more in equilibrium. You're not getting as many of these random shocks. But actually, one of the things that you see, and from a technical analysis perspective, there was always this idea when markets are just up in a range, that they are building up because you have buying and selling behaviors, positions being developed, and that once you get the external stimulus, that's when you can get a big move. So you've seen that. You've seen a reasonable size in gold in the last couple of weeks, whereas it had been trading, say, between 17.40 and 18.20 for a few weeks. Crude is another example. The euro, was trading, if you go back over the last decade, it was in a range for a long time and then had a breakout. So it's like the idea of the Minsky moment, that periods of stability are laying the foundations for periods of instability. So you can get these periods of quiet in markets where trend following won't do well. Markets can be broadly in equilibrium, but that could be laying the foundations for periods of dislocations in markets, which is what we're seeing now. So we've actually had a period of more quiet markets for a few years, and now we're seeing a period of more volatile and more dislocated markets.
Yeah, no, I like that. That's a great number of really important points. A couple of thoughts on my side when I hear you speak like that. One is, by the way, another interesting observation is, of course, that oil actually traded for 30 years between $15 and $30 from the 1974 to 2003. I think it was really stuck in that range, which, of course, is still 100% different from the low and the high, but I mean, nothing compared to what we've seen since. So that's interesting. Of course, it also, kind of confirms why you need to be fully diversified as a trend follower, because there will be times where a market or sector stays in a range, like we've seen currencies for the most part for a decade or more for various reasons. I like your kind of explanation as to why do trends occur. And I think a lot of investors, especially on the institutional side, kind of want us to be able to answer that question, right? Because I think for many other strategies, they will always ask, so why does your strategy work? What's the thesis behind it? You want something, and I'm reminded about. I have a couple of sort of thoughts on this. One, I was reminded when you were speaking of my conversation with Professor Andrew Lowe a few years back. Of course, he is the proponent of the adaptive market hypothesis and not a subscriber to the efficient market hypothesis. So when I asked him about it, I remember him saying, "Well, markets are efficient, but only." Sometimes, right? And sometimes you get this because, as you rightly say, for long periods of time, they can be in some kind of balance, and there is no, and you can say, yeah, they look pretty efficient and they're not moving a lot. But then there will be something happening that makes this balance tip to one side or the other, and that's when you get your big market moves. The other thing I was thinking of when you were talking is that I think partly why, and I'm putting together this as my own thesis, and I don't know that today I'm going to kind of go into all of the details of it, but one of my inspirations in terms of answering the question that I think a lot of people have been mulling over and voicing is this kind of, have we seen a degradation of trend following returns in the last decade or two compared to the 70s, the 80s, and the 90s? Lots of people want us to kind of admit that, which is hard to keep the fortress on this one, because returns have in some years been lower than expected. But I think on Wednesday, I'm going to be releasing a conversation that I had with Rob, but also with one of the authors of a book called The Rise of Carry, Kevin Coldine. I was planning to do it last week, but something came up and we released the Harry conversation with Alex Gorevich, which was really, really interesting, by the way. So basically what Kevin and his two co-authors, Jamie and Tim Lee, wrote about is this carry regime. Interestingly enough, we've just talked about carry, but this carry regime where investors have been rewarded for doing nothing other than owning bonds and fixed income, sometimes in a leverage fixed income version. And this carry regime have stayed with us for a long time, partly because central banks were able to manage a lot of things into this stable world. But as we're starting to see now, at least that's my thesis, and it's also the author's thesis, but maybe for different reasons, this carry regime is coming to an end. And it's been at least 2 or 3 decades that we've seen this, more so in the last decade or two. And as you rightly said, going back to kind of technical analysis, going back to George Soros, et cetera, if you've had a certain regime for a long time, actually what you could expect is something really violent and brutal in the other direction once it ends. And that's kind of what I'm thinking. I'm seeing the beginning. And by the way, I'm going to bring in a lot of stuff that we've been talking about on the podcast for a long time. And I can't remember exactly when, but there was certainly a period where we talked about the fourth turning. I don't know if you're familiar with the fourth turning, but the fourth turning is generational cycles, right? And Neil Howey and Bill Strauss wrote about this back in the early 90s, where they predicted that the fourth turning, which is the worst one, that's the crisis turning, and a turning is about 22 years. They believe that, although they predicted it to start around 2005, I've heard since that Neil said, yeah, it probably started in 2008 with the great financial crisis. And so we should expect this to last to 2030 or maybe 2032, thereabouts. So we're still far away from that coming to an end. And actually what Neil says in the book and Bill Strauss says in the book is a lot of people think that the big crisis is at the beginning of the fourth turning, because the great financial crisis, what could be bigger than the great financial crisis? But he says, no. The big crisis comes towards the end. And so if we and I certainly don't hope this is the case, but if we see what's happening in Europe in the last couple of months and what we have started to fear could escalate into, now that's something that fits a fourth turning, because all big wars, both in the US, revolutions, world wars, They all come during the fourth turning. So what I'm just saying here is I think that there are ingredients from many sides that I've seen, books that I've read, guests that I've spoken to. And I think this is where we've lost as investors and maybe as humans. I think because of this stable carry regime, I think we've lost our imagination to be able to understand or even comprehend what an environment could look like if we go back to something that fits, say, a generational fourth turning. And then we can obviously move it further and say, well, what kind of strategies would you like to have in a world that goes completely crazy and where you have market moves similar to what we've seen in the last 6 weeks? Do you want the stable 60-40? Do you want risk parity? Or do you want trend following that doesn't predict anything, that just follows these crazy price moves and hunts for the outliers that are surely going to show up in a period like that? That's the question investors have to ask themselves. And I'm not trying to scare anyone when I say this, but I do encourage people to prepare. And if it's meaningful for them, to protect their portfolio, then trend following should have a meaningful allocation in their portfolio. That's how I see it. And, we've been doing this podcast for 8 years now, and it's been not always the most exciting thing to talk about because people were poo-pooing the strategy because it had a couple of quiet years and had some drawdowns and so on and so forth. But I think people are starting to see the value of what it brings to a portfolio when something unexpected happens. So those are some of my thoughts, at least the ones I remember.
No, I think you're right. I mean, we've had that period, and it's not like we haven't had any random events in the world. We've had Brexit, we've had different things going on in the world.
Sure.
But if you look at the last decade, by and large, it was a period of fairly subdued economic activity in the sense that, no boom, no bust.
I think there's one more thing we have to add to this, and that is, yes, we've had some unexpected events. We've had a great financial crisis. We've had COVID. We've had, other things happening in the last 10 or 12 years. The difference is that at those times, central banks had the ammunition to do something about it and to create this cushion, this stability, so to speak, buy the dip mentality, not least because they didn't have to battle inflation.
Yeah, and there's a debate as to why that was the case. It may have been the case because of the disinflationary dividend that we got from globalization and China and Eastern Europe coming into the world trading system that some people are arguing now is gone. Some people still say the disinflationary bias is still there because of debt, etc. Remains to be seen. But certainly there was never a policy dilemma in the last couple of decades for central banks. As soon as there was a crisis, it was very easy to ease policy, and that was what politicians wanted. That's what the markets wanted. But you have a conundrum now if you get volatility, if you get risk events in markets, and it's obviously we're seeing at the moment that central banks have to now continue to tighten even in the midst of these events which maybe if it happened 10 years ago, the bias might have been to ease actually.
And you mentioned volatility, and I'm no expert here, but what I have noticed is that volatility seems to be much more persistent at higher levels in the last few months. I mean, and some of the relationship between what happens between the S&P and the VIX is kind of a little bit out of sync at the moment. I think there are signs for a change, and it could be a seismic change in the way market operates. I mean, I think just going back to what happened in the LME, right? I mean, they're starting to see examples of things that are getting a little bit out of hand here, which is obviously interesting. So another question that you raised, which is obviously kind of very natural to follow on a discussion like that, especially after 3 or 4 months where, it's been very, very productive to be in the trend following camp, is of course, is it too late to invest in trend following? What are your thoughts on that?
Yeah, I raised that just because that's the typical reaction you would get from investors and clients after a period like this, where maybe we were making the case for investing in these strategies, and then you see the very strong moves, and then people say, okay, you've had extreme moves in commodity markets, we're probably not going to see them anymore. And if there are gains, there probably will be reversals. And, it's very hard to disagree with that in some sense. I mean, there is we've had some seismic shifts in the commodity markets, and we don't know whether we're going to see more of them. But if you look back at the performance of trend following historically, one of the things that nobody has ever really found a mechanism for timing it. It's one of those strategies that people always want to wait to see it working before they'll jump in, and then it starts to work and they'll say, oh, have we missed it? It's really one of those things that should be a strategic component in your portfolio if you believe that this is the way markets operate. So I think, as you're speaking there, if we're in the midst of a regime shift, it's unlikely to be something that lasts for 1 or 2 years and then peters out. For sure, there may be a drawdown for trend following at some point. If you look at, say, the performance of trend following in 2008, I think there was a very strong start. There might have been a dip in the middle of the year, and then new trends emerge. So it's impossible to say when you're allocating to trend following, you're allocating to an approach to trading, to capturing moves in markets. And it should be something that is a strategic element to your portfolio rather than trying to time it. So no, I don't think it's too late. I think what you do see with some investors is rebalancing from time to time, although it's always tricky to rebalance and add to the exposure during drawdown. It's probably easier to take a little bit off the table after it's worked very well. But, as I say, even amongst the trend following community and the CTAs themselves, nobody has ever found a mechanism for saying this is how to time trend following. It's one of those ones that if you went through, take any trend following manager and went through the monthly return series, often what you'll see is a strong month followed by a strong month, and then there might be a dip, but then you can get 3 or 4 strong months again because new trends in markets. When you get into a market environment that's conducive for the strategy, often what you see is that the trends rotate, and that's what we've seen to up to a point now recently. So it's been, last year, the start of last year was probably copper, and we've had a big rebound in oil. Into this year now, we're seeing moves in wheat and nickel. Now I'm saying, okay, we possibly could be starting to see moves in currencies. Equities had been trending to the upside, now they've turned down. So it's impossible to predict which markets themselves will trend. But if we're into this market environment of more volatility, more dislocations, then you really kind of have to close your eyes and invest if that's what you believe is how markets work, and don't try and second guess it and don't try and time it.
Yeah, no, I love everything you said there, Alan, and I will say that I love when people, especially sort of potential investors who's been on the sideline and who missed the big move and never bought the dip, right? Of course, they buy the dip in everything else but trend following. So I love it when they come and we have conversation about these things and people say, no, exactly as you said, no, we've had all these extremes moves, definitely not the right time to buy trend following. And I'm thinking, well, you didn't predict it that we're going to have these moves in the first place. So how do you think you have any way of predicting that there's going to be a correction in these moves? That, how do you know? And it's a little bit like, with central banks, right? They never see any of these crises in advance, right? They never see them. And yet we still ask them to fix it afterwards, right? Which is kind of crazy. But so that's one thing I just want to say that, yeah, I think sometimes we just don't have to think too much. And as you rightly say, you need to construct your portfolio. And as I said before, if having lower drawdowns, having higher overall returns is meaningful for you as an investor, there's just no evidence to show that you shouldn't have a meaningful allocation to trend following. So that's one thing. The other thing, I just want to go back to the previous point we talked about, why do trends occur? And we're kind of expected to have a fancy way of scientifically explaining why trends occur before people would be interested in making an investment. And I'm kind of thinking to myself, well, why don't we just take a super simple approach? Why don't we just look at the markets? Let's look at 100 different charts. And if you can find me 100 markets that have made no moves, no trends in the last 50 years, okay, maybe you shouldn't invest in trend following. But as we all know, every single market will have a move or a trend on a regular basis. And so why do we need to have any kind of thesis behind why trend following works when we know that all we do is we wait for them to occur. We buy the uptrend, we sell the downtrend, and we can see them happening. We have all the evidence for hundreds of years of data. So why is it we still want to be skeptical about an approach like trend following, whether it should work or not? I mean, it's just interesting that there is so much resistance. It kind of going back to Abe's question that he doesn't think it fits his personality. And I think this actually even goes with investors who don't have to pull the trigger, but just because it, for some reason, feels really hard to own, which we can understand, we do, and none of us enjoys the drawdowns. On the other hand, wouldn't we rather have this kind of volatility that where we can at least see it historically and it's there, than investing in something that's never had a drawdown, so to speak, and then suddenly loses 30% of its value and you have no idea whether this is normal or not normal? So, I mean, I think it's David Drews who always said that the most robust strategies are actually the most volatile strategies, and I think he's absolutely right, because we realize volatility on a daily basis, not like private equity where, okay, it's not very volatile, sure, because you only price it once a quarter and you kind of very often give the price yourself. So these are the things that kind of box me from time to time when we get into it, as I'm sure everyone can hear that it's a bit of a rant today, but there we are. We kind of already talked about it, but I think we need to dive a little bit deeper because you brought another topic up as well, which I'm interested in seeing where you want to go with that. And well, actually, I do know where we want to go with this because it's inspired by an article from that we both of you and I read, and it's actually a really important article. I think it's in is it EQ Derivatives? Is that what the magazine is called?
Yeah, I hadn't come across it myself, but it was definitely.
Yeah. Some of my colleagues shared that with me, and so it's actually the topic of risk mitigation and investors' perception of trend following. So why don't you take that and give it a spin, and then we talk about it?
Yeah, it's interesting. I mean, the article was just talking about how public pension plans in the US have embraced risk mitigation strategy. So it's definitely been a theme that we have seen in the US investing community over the last 10 years or so, I would guess, and various organizations have been at the forefront in embracing trend following as a, what is called a risk mitigation strategy. So I think that's the CalSTRS. CalSTRS has been one of the large public pension plans in California. That's the label they've put on it, which makes sense. It's basically a component of their overall portfolio, which is designed to provide diversification basically to their more, I suppose, risk or growth oriented strategies. And within risk mitigation, you have trend following. Many institutions use long duration assets as well, treasuries, and they also use some uncorrelated kind of risk premia type strategies as well. Some other consultants and allocators call it crisis risk offset. So there's various names like this, but it's certainly been an interesting growth. And I mean, I think we would all say it's welcome that these pensions are embracing trend following for those diversifying characteristics. And, as Neil says, you've been saying, very often people will wait to see the performance before they get convinced. Whereas in this instance, we've seen this trend of these, sophisticated institutions allocating to trend following over the last decade. Now, interestingly, the article does highlight how they haven't got to their kind of target allocations in many cases, which is interesting. That's one thing. The second thing is that it's interesting now, it's almost like many of these organizations are now refining their risk mitigation strategies and thinking kind of a little bit more deeply in terms of thinking about what type of equity drawdown are they trying to manage against and which types of strategies will work. Should you have a mix of faster trend following and more medium to long-term trend following, and should other strategies be part of this? And the scenario that we're seeing in markets at the moment is kind of a market environment where bonds are not obviously being as effective in diversifying equity portfolios. Typically bonds will do well when you get an economic growth scare and the expectation of lower interest rates. Whereas if you get a shock that is driven by an expectation of higher rates, such as an inflation shock, bonds won't be as good as an equity diversifier in that sense. They'll tend to fall at the same time. So I think there's increased sophistication in the use of the strategies amongst the I suppose the early embracers. So I think that's good as well. I mean, it does strike me as well why we've got this, why certain institutions like CalSTRS have been at the forefront. Whereas if you look across Europe, in many instances, obviously not everybody, but certainly in the whole area of multi-asset investing and many typical asset allocation plans, you don't see that much representation in trend following. It does strike me, why is that? And is it? I know you've been talking to other guests, Niels. Is it the name? Is it the label that's put on it? Is it a misperception? And I think you're probably right. There's probably multiple things. If it was called, unconstrained multi-asset, would that change the perception? Or, what's the difference between trend following and, say, a global tactical asset allocation approach? Probably pretty similar. It just the inputs are different, but yet some strategies tend to get embraced more. So I think it's great to see that we have had that growth in some markets in terms of embracing trend following, and interesting how people are getting even more sophisticated in the use. But looking across the rest of the world, I think there's still lots of investors who are very much under-allocated to these types of strategies.
Yeah, I mean, I was kind of hoping, Alan, that you would have all the answers to this because, of course, you come from the allocator side and you've been dealing with, I'm sure, maybe not so much you personally, but of course, your colleagues with some of these institutions. But let me pick up on some of the points you say. Well, first of all, CalSTRS, people should go back, and even though it's a few years old, but I did interview Carrie Lowe, the CIO of CalSTRS, in one of the roundtable episodes a while back. They had their risk mitigation allocation for a while. It wasn't new to them, but it was, I think, quite new at the time that suddenly you had these big pension plans starting to carve out part of the portfolio to call it specifically risk mitigation, as you rightly call it. And back then, I think they had something like 35 or 40% trend following, and then 35, 40% 30-year bonds type stuff. And then, as you rightly say, a couple of other strategies, global macro risk premium type stuff. Clearly, I think her foresight and along with her colleagues have been proven right. I think also even though people might have a risk mitigation strategy, I think they might have to revisit it now because clearly the 30-year bonds part of that risk mitigation is not working out so well. It certainly hasn't done this time around in terms of the Ukrainian crisis, for the reasons we know why. But more importantly, I'm kind of hoping, I'm hoping, but I'm also fearing that many, many, many more institutions will now have to start thinking strategically about risk mitigation. And frankly, if they want to call us risk mitigators, that's perfectly fine with me. If it helps them get it into their portfolio, not because we as an industry really, it's not a sales pitch, but it is really important that the pension funds of the future, who after all have to meet the liability of our families, that they don't blow up in a world where maybe correlations of stocks and bonds goes positive and both of them go down in price. They need something else in their portfolio. The challenge will be, of course, could this cause a real surge in interest and flows into trend following? And what may that do to trend following? Will there be managers who are tempted to go for size above their natural capacity, and therefore returns will diminish? Or will people be strict? Because some of the managers who've done well in recent years, they have now come to their levels of capacity, and it'll be interesting to see whether they have the discipline to say no thanks when people show up with a $500 million ticket and say, oh, we really want you now. So that's going to be interesting for me to see. and to see the flows. I think you're absolutely right. The flows tend to come a little bit later. Now all the consultants have to kind of do their work and help investors find solutions as to how they can invest in trend following and with whom they should invest in their capital, the vehicles, and so on and so forth. But I would think it's almost unavoidable that we're going to see a higher level of interest and flows, for good reason, of course, into this space. Now, final point that we wanted to bring up was really something closer to your home, namely a little bit of what you've learned, maybe some of the key insights that you've taken away from the first few episodes of the Allocator series, which has been very well received. So well done on that, Alan. Some amazing guests, really great guests, very, very different guests, but all very interesting to listen to. Some great stories. We have had, the $25 billion pension plan, quite outspoken CIO. We've had, listened from the Queen's Bank type COO. We've had the mammoth $1.6 trillion portfolio CIO on the podcast, and many of them also who have written books on different topics, of course, around alternative investments and so on and so forth. So lots of things for you to have discussed with them, and I really encourage people to go back and listen to all of the episodes so far, and there's a couple of really good ones coming out going forward. Then we may take a break and then come back in a few months with another batch of Allocator episodes. But tell me a little bit about them, if you want to take a few things away from some of them and share that, so to whet the appetite of our listeners, feel free to do so.
Yeah, well, obviously encourage people to listen in if they haven't already. We've had some really interesting guests, as you say. A few points that that stood out for me. We spoke to, as you say, Sebastian Page, head of global multi-asset at T. Rowe Price, and he's written a lot of academic papers on the markets and portfolio construction. And one of the ones that he talked about was his paper, The Myth of Diversification. And it's this idea that you can have a portfolio that may look quite diversified, but you could be actually, what you tend to find with a lot of assets is they will become more correlated to equities in a crisis. So you can have a portfolio that looks like you're actually quite diversified. You could be in bonds and credit hedge fund strategies. But actually, you will have a bigger drawdown risk because these will become more correlated in a drawdown. So it's not just the amount of diversification, but the nature of the diversification. And that's where something like, he doesn't come from a trend following background at all, but all of his research that he does in his multi-asset portfolio construction is supportive of the idea of allocating to strategies like trend following and time series momentum and long short strategies, directional long short strategies like that. So I thought that was really interesting, that if you take everything that he says, it really supports the case for trend following, even though that's not his approach. We spoke to Alan Higgins, as you say, of Coutts. That was really interesting, very candid conversation. Alan reflecting on 35 years in the industry, and he has some great anecdotes from his time early in his career back in the late 80s, early 90s. And, one of the things that stuck in my mind was he was talking about how he was involved in currency markets and trying to predict currencies. And at the time, it's always tricky to try and predict dollar yen, but they brought in a guy who had a trend following model or experience allocating to trend following. And he had that early experience of seeing trend following working back at that period. And that has stuck with him, basically. So it's definitely consistent with my experience of working with allocators, that people who have been allocated at a time where it's worked and have seen the merit of the strategy have always stuck with that strategy and have that greater ability to continue to allocate to trend following and manage futures, because they've been there at the times where it's worked and it's been helpful in their portfolio. So interesting to see that from Alan. And also he's very good at highlighting how their team would look through the whole universe of macro strategies, and how it's often tempting to go for strategies with attractive Sharpe ratios, etc. But you really got to be careful about not picking up some inherent equity market beta with some of these strategies. And you have to differentiate between those ones that might just be uncorrelated with equities and those that actually have the ability to generate positive performance in times of economic and market stress, such as trend following. So it's very interesting from that perspective. as you say, we chatted to Elizabeth Burton, managing 25 billion at Hawaii state pension. Again, a very candid, interesting conversation, very open. And Elizabeth has, very differentiated views, I would say. One of the things was, do we need all of these asset class categorizations? Private debt, private credit, equities, public equities, private equities, etc. And I think what she says has a lot of merit, that you have a lot of different flavors of equity and growth risk, in portfolios, and you have different shades of it. But ultimately, you have kind of growth or equity type strategies, and you have diversifying strategies, and you have different flavors within all of that. But maybe having all of these buckets can constrain people at times, and well, can we allocate to this manager? We already have a manager in that bucket. It can actually be detrimental to performance. So that was really interesting to get her perspective. We had Chris Schelling and Phil Huber, both authors of books recently on alternative investments, on portfolio construction, on manager selection. A lot of good stuff in their books. And interesting, we got quite deep into the whole area of manager selection, I would say, with Chris Schelling, the behavioural challenges of selecting managers. And this is something that I feel everybody is aware of, but nobody really has a strong set of answers as to, overcoming those challenges. Everybody says, well, ultimately it is just really difficult to overcome behavioural challenges, but you just have to try and put in place as good processes as you can. And that was something that came out, Chris, the whole idea of, don't just meet one manager, meet 100 managers to really get a sense on, okay, what does it take to be good at doing a particular strategy? So repetition as a means to upskill in terms of manager evaluation, and then, putting in place certain processes to try and overcome those biases. And obviously with Phil Huber, he's gone through the whole gamut of different alternative investments and the merits of all of those, but also a big proponent of, the use of trend following and managed futures in portfolios. So we've had the kind of the institutional multi-asset view, we've had the pension view, we've had the wealth management view. We will have more guests like that in the coming weeks from those types of investors and more. So certainly very interesting, really enjoyable so far. So definitely encourage everybody to listen in if they get a chance.
Yeah, no, I certainly enjoyed them a lot, and I agree with some of the things that you said in terms of some of the highlights from the conversations. Of course, you and I recorded this week. It's going to come out in 10 days' time or so. A conversation with Ted Seides from the Capital Allocators podcast, and who, of course, by background has been, used to work at Yale endowment, and of course had his own kind of fund of funds firm for quite a while, where he made the famous bet with Warren Buffett that ran for 10 years, hedge funds versus the S&P. So and he also actually had some really interesting insights in terms of some of the points like manager selection, etc., etc. So yeah, hopefully this series will continue with just inviting people with different views, but on the same topic, not always agreeing, but giving us a chance to think about some of these things. And so, yeah, lots of things to learn from that. Let me turn quickly to a little bit of update on performance, since I can see we're already running long. This so much to talk about, Alan, with you. So anyways, but as of Thursday, performance was still pretty strong. I think I can't remember yesterday, probably mixed, not a big move either way. But as of Thursday, at least, the Beta 50 index up 4.06%, up 7% so far this year. SocGen CTA index up 5.8% for the month and up 10.78% already this year. SocGen trend index is flying, up almost 7% in March, up 14.76% for the year. And the SocGen short-term traders index now really picking up now to up 2.4% in March, up 4.14% for the year. As I said, my trend barometer closed at 70, which is pretty strong. MSCI World Index turned around, had a great week in equity space, up 1.1% for March, but still down 6.8% for the year. And the World Government Bond Index, apropos our conversation today, another down month, down 1.4% so far in March. Of course, if you like what you hear and you want to help us, please go to Spotify or go to iTunes and leave a rating and review so more people can find the podcast. Next week, I'm joined by Mark, and that's always going to be really insightful. So please send us your questions, info@toptradersunplugged.com, and we will do our best to answer them. I think that's it for now from Alan and me. Thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as always, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.